Hello, investors. It's Don Vandenbord, Senior Portfolio Manager for Revere Asset Management. Today is Thursday, July 6th, 5:46 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Got to rush through this one. We've got some really bad thunderstorms going on right now. State of the market, we are in an uptrend. Took a bit of a hit today, and we'll talk about that as we get through the video. Leaders, uptrend, not a problem there. A couple of them testing or right on the 21-day moving average. As far as the major indexes go versus the three time frames that we track, the Dow and small caps closed below the 21 today. Medium term 50-day moving average, we still have the NASDAQ 100, which gapped down but rallied off the lows, still 6.7% above the 50-day moving average. That is stretched by historical norms. Long term, looking fine against the 200-day moving average. So what happened today? Woke up, we were gapping down a little less than 0.5%. Then at 8:30 a.m., an ADP employment report came out, and the number of job ads that were expected was blown away by the actual count, and the markets did not like that. Interest rates immediately shot up because that implies that the Fed still has more work to do. The Fed wants a slowing economy, slowing employment to try to engineer some sort of a soft landing where they don't have to be continually raising rates and worry about inflation at the same time. But this shot rates up, including the 10-year above the 4% level, which is kind of a flashing light level, so to speak. So rates above there, stocks sold off. We opened down 0.8% on the S&P, 0.9 on the NASDAQ 100, 1.3% on small caps, and things didn't get any better. We continued to bleed down for about an hour and a half, almost 2 hours before we bottomed. So we went from a trend down, and then we started trending higher. And then about the last 90 minutes of the afternoon, we just went sideways. So it was the tale of two trends. The markets closed just about near where they opened, a little better, a little worse in some cases. Uh, Solace or safety was found in Microsoft and Apple, and that both of those finished positive today. Nvidia only down 0.5%, Meta only down 0.8. So that's where the money flowed. That's keeping the Nasdaq 100 extended. It didn't spare the SOX. Well, the SOX came back quite a bit from where it was, but it didn't spare banks or small caps. Again, they bounced, but they were weak today. So here are the final numbers. RG8 is our 8 ETF growth composite, down 1.6%. S&P down 0.8. NASDAQ 100 about the same. Dow down 1.1, mid caps down 1.1, Russell down 1.6, global diversified 60/40 down 0.95. Global stocks were lower when I woke up. They didn't get much better. In fact, ACWI, which is the all world, finished down 1.2%, worse than the S&P, dragged down by foreign stocks. In-house GROTECTION, we took a hit down 1.64%. We've been had more exposure than market. That's what we do in uptrends. Some of the stocks just didn't hold up as good as we expected them to. And we also had small caps, which took a hit, and we had semiconductors, which took a hit. We got stopped on a couple things, hedged a couple things. We'll talk about that when we get into the tail of the tape and the charts. Let's get right into it. Here's the S&P 500. You can see this close is a good close. Let's go to the 5-minute. So you can see the gap down and harsh sell-off. We were down 1.4% at the lows, then turned on a dime, rallied up to just about where we closed early afternoon. Little attempt at a run higher, up to 44.16-ish, and then sideways into the close. We opened around 44.10. So got above the open, basically closed just slightly above where we opened. So what does that mean? Well, it's a line in the sand. It's an inflection point. Today's lows, the market attempted to sell off. We rallied off that lows. The good thing, and I'm going to go to a slightly longer term chart here. Let's go to the 60-minute. You can see this 4,400 level. We got back above it last month and then failed 2 days above it. failed, gap down. Uh, in this case, 4,400 turned from what was resistance uh, into support intraday and then broken, and it became resistance again on the 20th. We pulled back, tried to, make a challenge at it, didn't do it. Then we had this big gap up on 6:30 Friday on the tame inflation numbers. So we broke across 4,400, flipping from resistance to support. So the question was, as we were coming down this morning, is 4,400 going to hold? And it didn't hold. And we went lower, and there was really no sign of the selling letting up. We got first thing we did is put a hedge on when we broke 4,400, and then we tried to give our small cap and our semiconductor positions a little bit more room, but eventually in waves, we got taken out of those. And then we regained 4,400. So then when you regain a level, you look, are we going to back test the level? If we back test the level, are we going to hold it? So we poked our head above it, failed, poked our head above it, failed, poked our head above it, and then started to run. So it was at this point that we said, okay, we're back above this key level. Let's take off, or let's. At this point, we had sold down here. Uh, we got stopped on the small caps and semiconductors. So at this point, when you regain a key level, when you fail, regain a key level, test it a couple times, hang around it, and then start moving higher. We then put on a long to offset the hedge that we put on. The hedge was on the NASDAQ 100. We saw NASDAQ 100 stocks starting to come back and outperform. We saw Microsoft green. We saw Apple trying to turn green. Meta was green at the time. NVIDIA was coming off the lows. So we put the SQQQ hedge on back here when we started to break down. And we just put on an equal percent of S&P 500 to offset that. So basically, we cost ourselves 0.09% by putting on the hedge and then taking it off. A little bit more than that because of where we got stopped. But again, we don't have a crystal ball here. What we're doing is trying to uh, put stops in place for everything that we have. We don't want to give back all the gains. You don't know how low things are going to go. We've got levels for everything that we own. We've got levels for overall portfolio. And when they get taken out, they get taken out. If they reverse, you take appropriate action. So when we got back above here, and anytime we tried to come back to 4,400, it survived. So then around 44.05 and 44.09, so our average is 44.07. That's when we put on SPXL to offset SQQQ. And then we tested here. This was the biggest test in the afternoon. Came right back to 44.05, survived, went higher, broke higher again. And then you can see the base into the close. So that the bottom line was step one, put on a hedge to see if we can survive. We don't want to throw the baby out with the bathwater, and we need to ascertain what's going to be strong and what's going to be weak. And that does not often become apparent until after the initial move is done. So you don't want to get rid of the baby with the bathwater, so to speak. So you can see that we reached a low. We undercut 4,400. We regained it, closed right on the ADMA, just actually a couple hundredths of a percent below it. But all in all, this is a win for the bulls as long as today's lows hold. Let's go to the NASDAQ 100. This is where we put the hedge on when we broke below the ADMA, and this closed back above the ADMA by the close at the highs of the day. I talked about the stocks that were strengthening. Note a couple things. One, we are continuing to make lower lows or lower highs on a relative strength basis. Also notice this orange line that we added. This is a feature that was added to MarketSmith. You have the ability to specify a moving average for the relative strength line. And this is, we've been looking at this a lot. We implemented it. I heard Mike Webster talk about it on IBD Live, how he uses it, and we're going to start making use of it. It's another reference point, another decision point to separate weakness from strength. And it's just a moving average of the relative strength line. So we undercut that intraday, got back above it. So that's a good sign. That was another reason why we wanted to offset the hedge that we put on when strength started to come into the market. So there's NASDAQ 100. Same thing, a line in the sand now. This is an inflection point. Try to sell off. Buyers come in. Now we just want to make sure that those sellers don't overwhelm the buyers that came in at the lows of the day today. And as I said, 6.7% above the 50-day is still pretty far extended. Let's go to the Dow Jones Industrial Average, one of two indexes that closed below the 21-day moving average today, just barely below it, also off the lows back below 34,000, which has been pretty much a support resistance battleground for the Dow. Relative strength continues to lag on the Dow. Mid caps have been stronger than small caps. Briefly undercut, but reclaim the 21 here. This looks like a normal pullback on mid caps. IWM definitely weaker. Banks and oils undercut, bounced near this 180 or the 50-day moving average, but clearly spent the whole day below the 21-day moving average, which has now rolled over. Now we want to see this regained as soon as possible, preferably tomorrow, because two closes below is more of a trend than a single occurrence. The VIX spiked big time today. At one point, it was up 20% late morning when we were selling off. That came off when the market uh, started to rally and close back below the 50-day moving average, but above the 21-day moving average, which is now curling up. This is going to put us a little bit more on the defensive side of things. UUP, the dollar, uh, had a negative reversal, started down, got stronger as the market was coming off, and then it started selling off while the market got stronger. So weaker dollar versus stocks, that inverse relationship was intact today. How did that impact precious metals? Gold was pretty solid most of the day. You can see the tight range there, but did finish lower, down 0.3%. GDX, however, after being rejected at the 21 yesterday, closed below the 200-day moving average today, down 2.6%. So much for that attempted rally. SLV, silver, is that the same amount? It was yeah, down 1.79%. Silver bounced at the 200-day moving average. Bitcoin rallying overnight, ended up on the day down 0.55%, closing right on the 21 day moving average. How about bonds? Bonds were weak all day. Bond prices were weak. So you can see this clear break on the bond index. Now, remember this abandoned baby bottom, which led to an abandoned baby top in rates. We want to see if that's going to be the case here. This is a big gap down on the broad bond index, breaking below the low of the range. Let's show TLT, same situation, below 100. Remember the below 100 down here. We battled 100 back here. We held 100 here. Is this going to be a one-day thing, or is this going to be rates continuing to go higher? So let's flip this now and look at rates. Here's the 10-year. You can see this clear break above 40 corresponds with this clean break above 40 that we had back here in late February. Again, is this going to be the beginning of a trend, or are we going to pull back? So when we pull back to 4% here, we'll see, which is basically this 40 level. Let's look at TYX, the 30-year bond, the long bond, right on this 40 level today. You can see the resistance that we broke above and failed here. We failed here. We're at this level again. So top of the range for rates, bottom of the range for bond prices. We need to see how this is going to play out. So that's it. Let's hit for the tail of the tape for asset inter-asset correlation. So back below the 21. Mixed results on the stochastics now that we're watching. NASI, this is probably going to flatten when it updates. Dollar, I mentioned this last night, that breakout 4-month high on TNX. Well, we made a higher high today on that, and stocks certainly didn't like it. Although, as I said, things did moderate a little bit in the afternoon, but this is definitely something we're keeping an eye on because high rates are the bane of growth stocks existence. Let's say that. So news, it was the ADP huge beat. Jolts, this is job openings, basically in line. ISM services, slightly above expectations, but it was the ADP huge beat. Now, is this going to be completely undone? ADP and NFP uh, very often don't sync with each other. Now, if we see a huge jump on NFP, that's the government payroll report tomorrow, that'll confirm ADP and stocks didn't like it. If it comes off and it's weak, maybe we rally. Um, Strange things don't always happen the way you expect them to, but we knew we were extended. We knew we got the gap down. We put the hedge on and we rallied. So we'll see what the reaction to tomorrow's jobs report does. But as far as the day count does, still a 23-day rally, but down 2 straight days now, basically right on the ADMA, 28 days above the 21. That's a little long in the tooth. And still extended 6.7% above the 50-day. We did undercut and reclaim the support resistance levels, 4,400 on the S&P, 366.50 on the NASDAQ 100. It was a tale of two trends today. We did all 11 sectors negative. The only ones that showed relative strength were XLK because of Microsoft and Apple. They're the two biggest stocks in XLK, and XLP Staples, which is where money goes to hide, um, but not a good day. Semiconductors, software, oils, builders with the higher rates, banks, gold stocks, biotech, and solars. Just bad across the board. So what we do in house, I talked about the hedge, SQQQ. We later offset that with the SPXL buy. We did get stopped on TNA and SOXL. That cost us probably about 20 basis points. But we're heavy long, which we do when we're above the moving averages on the Nasdaq and the Q, and we lost a bit more today than the S&P 500 did with the rally with 60/40, kind of in line with what RG8 did. So the net change to the portfolio was selling what we sold, putting the hedge on, buying SPXL was about a little bit more than a 10% reduction in exposure down to a 1.95. Bottom line for the day, strong ADP report spikes rates and hit stocks, but we did close off the lows. Now we go to the NFP report tomorrow morning to see how the market interprets that. Uh, the market does not like higher for longer, plain and simple. Strong economic data coming in is not what was expected. I mean, really, at the beginning of the day, at the beginning of the year, any strategist, and this is just an indication of how dumb it is to follow people's opinion. Everybody said a big recession's coming. All of the targets for the S&P 500 were down in the mid 3000s, low 3000s. JP Morgan's and Morgan Stanley said the sky is falling, and they've just been wrong all year. Um, Led by the big cap tech names and a renaissance in, well, not a renaissance, but the showcasing of what AI can do for different firms has led the rally. Didn't hear much talk about that at the beginning of the year either. So, not exactly forward looking individuals on Wall Street. That's why we'll stick with price, volume, and relative strength to tell us what to do. So, let's take a look at some. Uh, when you have a day like today, you want to take a look at your holdings as well as anything that's on your watch list or your universe list, because they say the pullback reveals the true strength. Well, it also reveals the true weakness. So we want to see what fell apart. One particular stock that comes to mind that has fallen apart the last 2 days is AEHR, after having an attempted rally that failed last Thursday, another or last Friday, a big rally on Monday, a big downside reversal yesterday, following more to the downside today. It closed below the 21, terrible relative strength this week. So not a winner for AEHR this week. Now the indexes are down. The Nasdaq 100 is down for the week, so we always want to compare everything to what they're doing. A couple things that we had that did in the 21 over 21 that have broken or tested the 21-day moving average. Generac, harsh 2-day pullback, definitely not a winner the last 2 days, sitting right on the 21. Uber, we own this. We sold part of it on the weakness last week. We're looking stupid for doing that. Now they're having to sue New York, who has a law that says all delivery drivers have to get at least minimum wage. That may be weighing on it again, but regardless, it did not rally in the afternoon with stocks. That stood out to us, sitting just barely below the 21 EMA. Another move below today's low, and we will be out of Uber. What else? DraftKings, this has always been a tough stock to hold because of its jagged action. After a couple of good weeks of success with DraftKings, it's going to sell off. This has been a loser this week. Closed below the 21, still holding this 25 level. Semiconductors where we got stopped out of, so they broke below the 21. We got taken out in two tranches. Closed right back above the 21 here. This is actually a very low risk entry to go along with a stop below today's low. But we do have NVIDIA still as our biggest position, so it's not like we are out of semiconductor land. And some things that outperformed today that we're holding. DT has been a relative strength, weakness, stand out lately, but it's been stubbornly holding the 21 and consolidating. There's a nice downtrend line here. And after the initial gap down today, it just slowly trudged its way higher. So definitely showed relative strength. So this one gets an A on the day. Celsius early, this was green, sold off, came back, bounced at the 21. Give this one a B. Live Nation, pretty strong most of the day. See, things where people are still going to spend their money. If the economy is too strong, those aren't going to sell off. LYV, tight range, low volume. Well, volume ended up even by the end of the day, but inside day today, holding the ADMA. If you got something above the ADMA, that's really strong on a pullback like you saw today. How about mixed bag today? MDB was weak most of the day, closed right at the 400 level by the end of the day with a hammer. Note that the pullback the last 2 days has been on volume much lighter than these 3 days that stand out on the upside. We still have a 4% size in this. And NVIDIA with a great comeback, closing at the top of its range, undercut, reclaimed the ADMA by the end of the day, volume below average. Look how low the volume is really all week. It's expected the day before the 4th, but this week too. The selling hasn't been intense in NVIDIA, and it's holding up very well. Tesla, I'm basically going through the portfolio here. Down 2%, really not a big deal after a big up day and then holding it the next day. And then kind of neutral today on Caterpillar being down 1.7%, holding above the 21, volume a little stronger than I would have liked it to be. SMCI, normally a very volatile stock, held up pretty well for the most part today, closed mid-range, didn't break below the ADMA. I think I hit everything. Yes, I did. That's everything that we own in-house. Something that closed green today or was very strong, Dave & Buster's. Again, people are going to spend money here with a good economy. Those things aren't getting hit. Let's see what else. Snow, one of the software stocks, they really didn't fall apart today. It bounced at the 50-day moving average. This has been one of the weaker ones. But it did bounce at the 50-day moving average. And that's going to wrap it. Here, one more strong one today. Fortinet, FTNT, big gap down, bounce at the 21, strength on the rally. Good stuff here. So that's going to wrap it. As always, love to hear from you. Don at revereasset.com. The phone is 855 Real Wealth. That's 855 732 5932. We entered into some capital preservation mode today when our stocks got hit on the gap down. But we're looking for, if we hold today's lows, looking to deploy some money into things that have held up today, because as I said, strength and or weakness are revealed by the pullback. Now that we got a pullback, let's see what the first ones are going to be to attempt to make new highs. And also remember, it's not how much you make in the market, it's how much of that you can keep. And that's why we take this approach at Revere. So email don@revereasset.com, 855 Real Wealth. That's 855 732 5932. And with that, I'll wrap up Thursday, July 6th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.